Hi, everybody. This is Alan Ellman, the Blue Collar Investor, and welcome to this BCI podcast number 156 titled, Was I Correct to Close My Successful Covered Call Trade? We're going to be using a real-life example with Revolve Group, Inc., which trades on the New York Stock Exchange under the ticker RVLV. Okay, a lot of times we look at trades that we've suffered through. This one is an enjoyable trade that turned out way better than we ever anticipated. So it actually turned out to be a 4-day trade. But when it was started on 6/21/21, 300 shares of RVLV were purchased at 61.83. And immediately after purchasing the shares, the July 16th, 21 65 call was sold at 259. So buy the stock at 61.83 and agree to sell it at 65. 65 being an out of the money covered call strike. Now, 4 days later, what happened? RVLV was priced at $70. So it went from 61.83 up to 70 in just 4 days. Well, at that point in time, the trade was closed. The July 16th, 2165 calls were closed at 671, and the shares were sold at $70. So when one of our members presented me with these trades, the question was, did this make sense to do? So let's first have a look at the price chart of RVLV from those 4-day periods from 6/21 to 6/25, 2021. Now, for those of you who are also watching this podcast, I'm showing a screenshot now, and in the brown field towards the right side of the screenshot, you could see that RVLV was an impressively trending up chart pattern, very bullish chart pattern, particularly during those 4 days. But actually, it had been trending bullish since October through June, and then it continued to be bullish through August, as it turned out. Okay, so that's the reason why an aggressive stance was taken by selling the out of the money call. Now, if we take a look at the initial trade structuring and initial calculations using the BCI Trade Management Calculator, and I'm going to describe the screenshot for those of you who are just listening and not also watching this podcast. On the top part of the screenshot, we make our trade entries into the blue cells of the BCI Trade Management Calculator. So we put in the price of RVLV at 61.83 and the 65 strike with a premium of $2.59 per share. Now, the lower part of the screenshot shows the initial return, the RU, return on the option, as 4.19% for a 26-day trade if taken through expiration, and obviously it wasn't. And the initial structuring showed an annualized return of 58.81%. So a very nice return if, in fact, the price of the underlying security didn't go down significantly. As it turned out, it actually accelerated significantly. And the upside potential was then at that point in time 5.13%. That is the additional profit if the stock moved up to that 65 strike. Well, actually, it moved up to the 65 strike and then well beyond it, as it actually was $70 at the point in time when the trade was closed. The short call was bought back and the shares were sold. So now, how do we know whether or not this made sense to do? Now, part of the trade management calculator, there are two worksheets in the bottom tabs, and one of it is the Unwind Now tab. And that's what we're going to use to find out if this made sense. So into that tab, we put in the initial transaction date of 6/21. The expiration date, you recall, was July 16th. The price of the stock initially 61.83. The 65 strike was sold for 259. Now, on the adjustment date, 4 days later, the price of the stock had moved up to 70, and the cost to close that 65 call moved up to $6.71. Now, what we do is we then look at the right side of the spreadsheet, and we see that the cost, the time value cost to close that 65 call is $171 per contract, those watching on the very bottom right of the screenshot, and that is a percent of 2.63% lost to time value lost when closing that initial short call. Now, the guideline in the BCI methodology is to consider closing both legs of the covered call trade when the time value cost to close approaches zero, and we can generate an additional 1% over that by contract expiration, by the same expiration date. So in this particular case, with the worksheet showing the time value cost to close at 2.63%, the question is, can we close and generate at least 3.63% in the next 21 days? Now, that is the question to ask. Otherwise, we would just take no action and continue to monitor this very, at that point in time, successful trade. Now, if the answer is no, or if we're unsure, then at that point in time, we just leave it alone and we would not move forward with that mid-contract unwind exit strategy. So if you're asking me at this point in time, it's a very close call. And in order to get that 3.63% over a 21-day time frame, we would have to use a fairly volatile underlying security. So although it's possible that we could get that 363, I'm going to say that most cases like this, I would not take any action and just hope to generate that maximum return, which at this point in time was looking pretty darn good. So generally speaking, it's really never wrong to take a 4-day return of 6.67%, combining the option premium with share appreciation up to that 65 strike. But we must have a structured system in place that will give us some guidelines as to whether or not we should execute the MCU exit strategy. Now, this is going to be very, very useful for us in taking emotion out of our trading arsenal. So once again, my gut is I probably would not have closed the trade, but it is in this case a close call. Before I go, ladies and gentlemen, for those of you who want to master the strategies of covered call writing and selling cash secured puts, our best and most comprehensive investment package, or our BCI package, is available on the website, thebluecollarinvestor.com. Just click on the link that says Best Packages. It has 18 components, and the 18th component has well over 200 components within itself. 6 online video courses, 6 calculators created by the Blue Collar Investor, and 5 of our best-selling books in ebook format, along with our premium membership, which includes the entire screening process, free calculators, ebooks, and well over 200 training videos. All that part of the BCI package. We also have a trade management calculator package. You saw it in action in this podcast, and that includes the TMC calculator, along with my 8th book, a new book on exit strategies, and a user guide for the TMC calculator. And you'll be given an opportunity to combine those two packages at a discounted price. So go to our website, thebluecollarinvestor.com, click on the link Best Discounted Packages for more information. Items can be purchased individually as well at thebluecollarinvestor.com/store. Ladies and gentlemen, I want to thank you so much for taking the time to watch and or listen to this BCI podcast number 156. Folks, I hope you enjoyed this presentation, but most importantly, I hope it puts cash in your pockets. As always, this is Alan Ellman, the Blue Collar Investor. Take care, everybody.